My friend Jessica, she's a night janitor at a hospital in Phoenix, just showed me her investment account balance, $847,000. She makes $31,000 a year cleaning floors, and she's beaten 94% of professional fund managers over the last 15 years. How? She does the exact opposite of what everyone else does when the market crashes. Look, I know what you're thinking. Another story about the lucky janitor who got rich. But here's what makes Jessica different. She doesn't read financial news. She doesn't watch CNBC. She doesn't even know what a PE ratio is. What she does have is something way more valuable than knowledge. She has a contrarian instinct that most of us lose the moment we start caring about money. I learned this the hard way. March 2020, when everything was falling apart. The Dow dropped 37% in 5 weeks. I'm watching my account bleed money every single day. And what did I do? I panicked. I sold half my positions at the bottom because it felt like the world was ending. Classic primate behavior. Jessica, she was buying, not because she's smarter than me, because she doesn't feel the fear the same way. Here's the thing. Contrarian investing isn't about being different for the sake of being different. It's about recognizing that markets are driven by human emotions, and human emotions follow predictable patterns. When everyone's terrified, assets go on sale. When everyone's euphoric, you're buying at the top. Think about that for a second. The entire financial media complex exists to make you feel something about money. Fear when things are bad, greed when things are good. Both emotions make you a worse investor. Jessica told me something that changed how I think about this. She said, "When people are scared, that's when I get excited. When people are excited, I take a nap." That's it. That's the whole strategy. But here's where most people get this wrong. They think contrarian investing means being a pessimist. It doesn't. It means being emotionally detached from the crowd. Let me give you a perfect example. December 2018. The S&P 500 dropped 19% in 3 months. Every financial headline was screaming recession. My coworkers were talking about moving everything to cash. Jessica doubled her contributions to her 401k. 6 months later, the market hit all-time highs. She'd bought the bottom while everyone else was selling. Now, what most people don't realize is that this isn't about timing. Jessica doesn't try to catch falling knives. She just keeps buying when prices are low and everyone else is scared. The math is brutal when you think about it. If you bought the S&P 500 at the peak in 2007, right before the financial crisis, you'd still have made 8.4% annually through 2024. But only if you kept buying during the crash. Most people did the opposite. They sold at the bottom and bought back in when things felt safe. They turned a 8.4% annual gain into a 3% loss. Your brain is literally wired to buy high and sell low. Evolution didn't prepare us for financial markets. Fear kept our ancestors alive when a saber-toothed tiger showed up. But fear kills your portfolio when the market crashes. And that brings me to the real question. How do you develop Jessica's contrarian instinct when your primate brain is screaming at you to run? I've been thinking about this for years, and I think I figured it out. Jessica doesn't watch her account balance during crashes. She doesn't read the news. She doesn't talk to other people about money when things get scary. She's created what I call an emotional firewall between herself and the crowd's emotions. Most of us do the opposite. We check our accounts obsessively. We read every headline. We listen to the talking heads on TV telling us why this time is different. We inject the crowd's fear directly into our decision-making process. Jessica's firewall isn't complicated. She checks her account once a quarter. She reads zero financial news. When the market crashes, she increases her contributions and then goes about her life. Wild, right? But here's the part nobody tells you. Building this firewall requires admitting something uncomfortable. You have to accept that you don't know what's going to happen next. Most investors think they need to have an opinion about everything. Will rates go up? Is inflation coming? Are we in a bubble? Jessica's opinion on all these questions is the same. I don't know, and it doesn't matter. That's actually the most sophisticated investment philosophy I've ever heard. I remember the moment this clicked for me. It was 2022 during that brutal bear market. I was stressing about my portfolio, checking prices every day, trying to figure out when to get back in. And I realized I was doing exactly what Jessica warned me about. I was letting the crowd's emotions drive my decisions. So I tried her approach. I stopped checking prices. I stopped reading financial Twitter. I just kept buying index funds every month like a robot. Best decision I ever made. Not because I timed anything perfectly, because I removed my emotions from the equation. Okay, so why does this matter for you? Because right now, you're probably making investment decisions based on how you feel about the market. When things are good, you want to buy more. When things are scary, you want to sell. That's exactly backwards. The contrarian approach isn't about being negative. It's about being rational when everyone else is emotional. Here's what that looks like in practice. When your friends are talking about how much money they're making in stocks, that's when you slow down. When your friends are talking about how scared they are, that's when you speed up. When CNBC is running headlines about market crashes, you buy more. When they're running headlines about new highs, you buy less. It's that simple and that hard. Now, if you're someone who checks their investment account more than once a month, this video is for you. If you've ever sold stocks because you were scared, this is for you. If you've ever bought stocks because you were excited about a hot tip, this is definitely for you. The janitor who beat Wall Street didn't have special information. She didn't have inside connections. She just had the discipline to do the opposite of what felt natural. Tonight, before you go to bed, delete the investing apps from your phone. Set up automatic transfers to buy index funds every month. Then stop looking. Your future self will thank you for it.